Hi, I'm Dan Fromer, founder and editor-in-chief of The New Consumer, and this is the inaugural Consumer Trends presentation in collaboration with Coefficient Capital. I'm a longtime business and technology journalist, and I started The New Consumer to analyze the intersection of consumer and tech, or as I say, how and why people spend their time and money. The New Consumer is a new kind of media company funded entirely by members, and I've been thrilled to have top founders, executives, and investors already part of the community. What and how consumers are buying is changing, and that's leading to a new wave of innovative consumer brands that live in online and offline worlds. That's where Coefficient is exclusively focused. Find them at coefficientcap.com. The Consumer Trends Report is our attempt to highlight what changed this year in the consumer world, including food and beverage, beauty, wellness, and fitness, and what we think will matter in the years ahead. We spent the last few months reviewing and analyzing data from dozens of first and third-party sources, including consumer spending data furnished by Earnest Research. Special thanks to them. We also launched our first consumer trends survey in partnership with Toluna. In November, we polled more than 3,500 U.S. consumers across a variety of topics, focusing on how and why their spending habits have changed this year and how they feel about their new habits. You can access the latest full version of this presentation at newconsumer.com/trends. I'll also be going into detail about our research for subscribers to The New Consumer. Join us today. The COVID-19 pandemic was the story of the year with profound global effects. By mid-November, more than 50 million people around the world had been infected, with more than 1 million dead. Its effects have been especially strong in the US, where more than 250,000 have died. The yellow line you'll see on charts throughout this presentation refers to the weekend of March 15th, a weekend where it felt like a switch flipped in the US and everything changed. As things are getting worse leading into the winter, this is the chart of the year. More big picture, the travel industry is one of many that collapsed this year, with air travel down more than 96% in mid-April, according to the TSA. Things gradually improved, but in October, travel was still down 2/3 from last year. Quarantine drove consumer culture in many ways, with fads like baking sourdough bread and jigsaw puzzles representing our new shared reality. This might be the other chart of the year, at least in our area of focus. As stores closed and consumer behavior changed, there was a dramatic rise in e-commerce spending in the US, passing 15% of total retail spending in the second quarter and roughly flat in the third quarter. This may normalize if more stores reopen, but we expect many new shopping behaviors to stick. Broadly, consumer spending in 2020 started normal and then split like a frayed wire. Some sectors, like grocery, home, and pets, had huge years as people were forced to reprioritize their lives. Spending fell or shifted in other categories like apparel, beauty, and fitness. One big beneficiary was Amazon. Another was the increasing array of direct-to-consumer brands that moved quickly to solve problems. Here's our view. Across the Coefficient Capital portfolio of digital-first consumer brands, direct-to-consumer revenue more than doubled since January. And companies were able to take advantage of declining customer acquisition costs as many big advertisers pulled back. Still, rough times ahead. COVID-19 has caused major damage to our economy and society, and it's clear that we aren't just going to go back to 2019 normal anytime soon. Now what? That's the focus of this presentation. We'll go through the habits and winners that we think will stick long beyond the pandemic shock and some of the most important questions and implications. One of the most interesting shifts of 2020, directly related to COVID-19, was the shift of billions of dollars of food and beverage spending to the internet. This directly affects how we shop and what we eat, with major implications for retailers, food brands, and beyond. The US grocery industry is a $1 trillion business growing about 2% a year. And e-commerce adoption is low, in the single-digit percentages until this year. Then everything changed in March. Just as restaurants had snuck ahead, taking the majority of Americans' food spending, that switch flipped. Spending at restaurants collapsed, many will end up closing permanently, and suddenly people had to cook for themselves. Households loaded their freezers and pantries for quarantine and beyond, famously buying up things like toilet paper and beans, but also ice cream, sodas, and other treats. And as lockdowns and health concerns kept many people at home, online grocery shopping transformed from a luxury convenience to essential infrastructure overnight. Before COVID, estimates for grocery e-commerce penetration for 2020 were, again, in the single digits. This projection from Mercatus and Incisive was 4%. But now the companies forecast around 10% e-commerce penetration for 2020. And they expect that to stick, doubling to more than 20% in 2025, another $100 billion heading online. In our consumer trends survey with Toluna, almost 1/3 of our panel said they were buying groceries online more than before. And younger consumers, which represent the future of the industry, reported shifting online at a higher percentage. Among those who switched to shopping more online, around half said they preferred their new behavior. The big early winners in this shift include Walmart and Amazon, the largest and most powerful physical and online retailers in the US. But Instacart is also on the short list. Based in San Francisco, Instacart is how much of the traditional grocery system has come online, offering delivery and pickup from around 40,000 stores, covering more than 85% of US households. The company has hired hundreds of thousands of shoppers this year to pack and deliver products. It's a good proxy for the broader boom in online grocery shopping. Instacart mobile app downloads spiked in March and April, according to Sensor Tower, fetching millions of new users. Downloads have settled around 1/3 higher than they were before COVID. Instacart is interesting because it's a fast-growing tech brand inserting itself between the retailer and the consumer. But it's also interesting because it highlights that online grocery shopping isn't just grocery shopping online. People shop for food and beverages differently online, and as more people shop there, that matters. For one, it's a fundamentally different user interface. Both involve browsing and searching, but wandering around a store, gazing at thousands of products, many familiar, many unfamiliar, actually being able to pick them up and look at them is a totally different experience than shopping for groceries online. One thing our Toluna survey found is that almost half of online grocery shoppers start their order with a previous order. This seems good for loyalty and retention, but it's currently a major problem for brand and product discovery. Instacart and Amazon see this as an opportunity to build out personalized advertising businesses. And Instagram is another potential path for discovery. But this also means that the winning brands will increasingly be the ones that can use technology to build communities and tell their stories online. Other constraints are different online. For example, many online grocers incentivize customers to spend a certain amount to reach free delivery, while shopping in-store may depend on how much you can carry or transport. The net result is that online grocery shoppers tend to spend more per session than in-store shoppers. Since March, the average Instacart order is around $120, according to Earnest Research, which is up from about $100 pre-COVID. In-store, the average basket size is around $60, up from $50 before COVID. But people also shop for groceries less frequently online. The average online grocery shopper made about 3 transactions in October. In-store, it's closer to 7. Another big shift to watch as food and beverage commerce heads increasingly online is the unbundling of the shopping cart. What is a grocery store? It's not just an online version of a physical store. Many different shapes and sizes of businesses are coming after food and beverage spending online. There are subscriptions and meal kits. One example is Freshly, which Nestle is now buying for almost $1 billion. Uber and DoorDash also want to deliver groceries to you. And GoPuff, a delivery-only convenience store, just said it would buy the liquor store chain Bevmo for $350 million. Internet-native grocers such as Thrive Market started off serving niche audiences and have since expanded. Imperfect Foods, for example, started as Imperfect Produce, delivering boxes of fruits and vegetables with cosmetic imperfections at a discount. It now has about 400,000 active customers across 40 states and has expanded to offer meat, seafood, and an entire range of products, an attempt to be your primary grocer, or at least one of them. The company tells us that its average basket size has doubled and that produce-only boxes now represent less than 15% of its business. And it has found that the more breadth it can offer its customers, the more likely they'll stick around. Customers who shop across meat, dairy, and alternative categories have 70% higher retention than produce-only customers. And many food and beverage brand startups, such as Amsam, a startup that makes delicious Asian sauces, and Magic Spoon, which sells low-carb cereal for grown-ups, have been able to quickly launch, iterate, and build businesses selling their products directly to consumers. House, for example, one of the latest Coefficient Capital portfolio companies, is a low-alcohol aperitif spirits brand that launched last summer. And thanks to clever navigation of regulatory details, it has built a direct-to-consumer business in most US states. This allows it to have a direct relationship with customers and quickly launch new products, bypassing the archaic liquor distribution model and slow-moving retailers. Sales are up more than 400% this year. Zooming out, the reality is that most people still do most of their grocery shopping at some sort of store. This spending data from Earnest Research, for example, shows that people who shop at the largest US grocery store chain, Kroger, do the significant majority of their grocery spending in physical stores, mostly supermarkets, but also discount and specialty grocers, and now about 20% of their grocery spending online. People who shop at Instacart, meanwhile, more of an early adopter crowd, do more of their grocery shopping online, according to Earnest Research. They still do more than half of their grocery spending in physical stores, but do about 35% of their monthly spending online. But here's what happens when you zoom in on one household's food and beverage spending, the new consumer household. This is my personal grocery spending since the beginning of 2019. It starts off almost entirely offline, and then as COVID hits in mid-March, shifts almost entirely online. In addition to ordering from Whole Foods, Sprouts, and other grocery stores using Prime Now and Instacart, I also used several internet-native grocers and ordered fresh Japanese produce FedExed from Suzuki Farm in Delaware. One interesting thing I found is that Amazon's share of my spending didn't massively increase as I moved more dollars online. It depends on the month, but Whole Foods was generally around half of my grocery spend when I lived in New York and shopped mostly offline. But as I moved more grocery spend online, even as a Prime member, Amazon and Whole Foods didn't monopolize my wallet. Another thing worth highlighting, I've been doing about 15% of my grocery spending directly with brands, including pantry items like grains and spices, great snacks, healthy cereal, tea, and seltzer water. That's a lot. If everyone shopped like that, that could represent around $150 billion a year moving directly to brands. I also spent almost $1,000 online this spring and summer on groceries and provisions from local restaurants that were selling CSA-style produce boxes, fresh eggs and meat, 5-liter jugs of olive oil, and containers of prepared foods. As the restaurant industry heads into a scary winter, it's interesting to think how groceries might fit more into their model, at least temporarily. Now, you'll see that as things opened up again in the late summer and fall, and as I got more comfortable going into stores and actually moved across the country to LA from New York, around half of my spending went back offline, including our favorite little neighborhood grocer and the farmer's market. But for the foreseeable future, and maybe forever, the other half has gone online, spread across a variety of formats, merchants, and brands. I've been unbundled, and according to our research, other consumers have too. Of course, this unbundling of the shopping cart isn't unique to food and beverage. In media, streaming continues to take share from live TV, now representing 25% of total TV usage, according to Nielsen. This has shifted attention and subscribers to Netflix, Hulu, Disney Plus, and YouTube, and away from cable incumbents. In finance, simple consumer services like Square's Cash App and Venmo, which is owned by PayPal, are unbundling traditional banks. And in retail, there's been a broader share shift in consumer packaged goods. Specifically, over the past half-decade, billions of dollars in spending has shifted from large CPG brands mostly to small brands and private label store brands, according to research by IRI and Boston Consulting Group. These look like small changes in share, 1% here or there, but in a market that represented more than $800 billion in spending last year, it's a lot of money and opportunity. 1% is $8 billion. What's happened this year, according to IRI's latest, is more of the same, but for COVID reasons. The big picture is that increased demand grew the industry, boosting sales for big and small CPG brands. But even when it looked like big legacy brands were making a comeback, small and extra small brands ended up gaining share. COVID has also brought upon a period of experimentation, both out of necessity and curiosity, where brand and merchant loyalty is up for review. By June, some 75% of US consumers had tried a new shopping behavior, including 40% that had tried a new shopping method, such as curbside pickup, and 36% that had tried a different brand, according to McKinsey research. Among those, almost 3/4 intended to continue with their new behavior, with Gen Z and high earners the most prone to switching brands, according to McKinsey. As with food and beverage, COVID conditions drove more commerce online across the consumer universe. Categories like apparel, where many stores closed in early retail lockdowns, temporarily passed 90% e-commerce penetration in the US, according to Earnest Research. Let's look more closely at beauty, which also had a year of ups and downs, depending on the category, and where there's been a fragmentation of brands. Some of that is generational. In our survey with Taluna, looking at makeup and beauty routines, we found that almost half of Gen Z and millennial consumers used 4 or more makeup brands, compared to 35% of Gen X consumers and 23% from the baby boomer generation. Younger consumers were also less likely to purchase makeup from a drugstore or mass discount retailer and more likely to purchase online. And beauty brand preferences synced up generationally in our survey too, as Gen Z and millennials are unbundling Estee Lauder and Clinique. Gen Z consumers were more likely to have purchased makeup by brands like Kylie and Fenty, while millennial consumers showed preference for Glossier and Charlotte Tilbury, among others. Some of the great unbundling is just the result of our new reality. That's the situation in the fitness world, where gyms closed, remained closed in some areas, and only recently reopened in others, setting up a boom time for home and online fitness services. When Equinox gyms closed during the pandemic, where did its members spend their fitness budget? Increasingly, according to Earnest Research data, at Peloton. The connected fitness company now has more than 1.3 million subscribers, more than double year over year, and engagement soared into the summer months. More broadly, fitness has gone online and increasingly at home, with apps like Nike Training Club and Strava fetching millions of downloads since March, further unbundling the gym membership. And Apple's new fitness service is on the way. In our survey, 3/4 of consumers said they switched to exercising more at home, and among those, 2/3 prefer it. The takeaway here is that, broadly, we believe this retail brand and channel unbundling will continue as more commerce and attention heads online. Some of it will be rebundled by aggregators. Amazon has grown its share of wallet during the pandemic. But Shopify now has more than 1 million stores on its platform. It's never been easier for a person to start a brand, set up a shop, and start selling online. There's a massive opportunity for small, focused brands to take share, and consumers are ready for it. Other trends on our radar: sustainability, and especially the reduction of single-use plastic, was supposed to be a big focus for consumer brands this year. In some ways it happened because people did a lot more cooking and cleaning at home for themselves. In our Taluna survey, among those who said they were using less single-use plastic in packaging, they cited having more time, becoming more aware of how much plastic they use, and being more conscious of the environment because of the pandemic. But COVID-19 also made hygiene and safety top priorities. Among our survey audience that admitted to using more plastic this year, that was by far the top explanation, cited by almost 60% of them. Plant-based meat. Almost half of consumers have tried plant-based meat, and among those, almost 2/3 are repeat users, according to a recent survey by UBS. Beyond Meat consumer sales have broadly accelerated, with a bit of a reset this past quarter as people ate through their freezers. Plant-based dairy alternatives, now a $17 billion global market, according to Euromonitor. It was a big year for oat milk. Sales in the US are roughly tripling, according to Nielsen, and Oatly has increased its share. In our survey, about 30% of Gen Z and millennials said they tried oat milk in the past 6 months, and around 2/3 had tried other plant-based milks. Drinking in 2020. In terms of format, ready-to-drink is expected to be the only category that grows this year, up 43% according to new data from IWSR. White Claw, hard seltzer, and similar beverages continue to gain in popularity and made sense this year when at-home drinking replaced a lot of restaurant drinking. By the end of this year in the US, ready-to-drink is expected to pass the entire spirits category by volume. We're also tracking the rise of low and no alcohol spirits. Beer and wine are both down this year, no surprise as restaurants, bars, concert venues, and stadiums were closed. But low and no alcohol beer is growing, according to IWSR. In our survey, about a quarter of millennials said low and no alcohol drinks have become part of their new consumption habits, with interest as well in CBD and THC beverages. Broadly, our Toluna survey also revealed that people still say they want to live a healthy lifestyle. Mental health is an important area for focus. Downloads for the meditation app Calm surged in the early days of lockdown. And in our survey audience, among those who said they've been eating healthy less, more than half said they've been stress eating and or feeling low. One upshot is that pet adoption has increased. We attribute that to the combination of less travel and the need for more joy. In the first 3 months of COVID lockdown, 5% of Americans adopted a dog and 4% adopted a cat, according to one study by the research firm Packaged Facts. And as the COVID vaccine approaches, one big question is, what happens to cities? Before the pandemic, the new urban renaissance was the mega trend, but this year was the Zoom boom. Remote work became the new normal, and cities shut down and really won't recover until vaccine distribution is figured out. Almost a quarter of our survey audience said they moved to live elsewhere for more than 2 months during COVID, with higher proportions of younger, more urban, and wealthier people. If applied to the US population, that represents almost 80 million people. About 4 in 5 have returned home, but the next few years could see some interesting migration patterns. And in the meantime, it is the new golden era of the restaurant drive-thru. It has been a year like no other, that much is clear. But as analysts and investors, we're most interested in the changes that last. What new habits and behaviors from this year will simply become the way life works? We believe that most of the shifts in e-commerce are here to stay over the long run, and in areas like food and beverage are underrated. For instance, we think this forecast underestimates the possible adoption curve, especially when you factor in the unbundling of the shopping cart. COVID brought an inflection point to online grocery shopping this year. And now that it's clear COVID is more like an 18th or 24-month interruption instead of 6 months, we believe it's more likely to stick for the long term. Led by younger consumers, that will make e-commerce the primary channel for a large portion of food and beverage spending. That represents hundreds of billions of dollars in spending that's up for grabs. We also firmly believe that direct-to-consumer is here to stay, and it will continue to grow across categories. And we believe that large strategics will accelerate their acquisition of DTC companies at higher multiples. The truth is that DTC brands serve customer needs better and more quickly than large incumbents. And when they iterate, they don't have to wait a year for the huge grocery chain buyer to notice them. In our survey, about 20% of consumers said they preferred to buy food and beverages direct from brands instead of through an online or offline grocer. Why? In increasing importance, feeling as part of a brand community, personalization, customer service, selection, and better quality. The future of consumer starts with small niche brands that know how to build community and relationships. The strongest ones are able to dictate their channel, and increasingly they're focusing on direct-to-consumer relationships. Retail then needs a radical reinvention. Over the next year, as we figure out how life looks post-vaccine, that's making it easy for customers to feel safe while shopping. Online ordering with in-store pickup is now table stakes. Look to the fast casual restaurant industry for innovative new formats, such as new Starbucks and Chipotle locations optimized for online ordering and fast, safe pickup. Today, it's convenient, but over time, it's building a network of different types of retail experiences across a neighborhood and city. Over the longer term, the retail winners will be the ones that focus on the things that you can still do best offline. Discovery, rich experiences, community, and personalized service, and where customer relationships are maintained seamlessly online and offline. Before I wrap up, I want to thank the team at Coefficient Capital for collaborating with me and the new consumer on this project. Special thanks to Arpan Ray and Natalie Borowski for their collaboration, and Franklin and Andrew for their perspective. Special thanks again to Taluna and Earnest Research for their time and resources. Bigger picture from this year's unexpected experience, we can promise you that it's almost impossible to predict what 2021 will bring. But we feel optimistically about the strength and the resilience of the consumer and the massive opportunity for innovation. Thank you for your time and attention.